Welcome back to the next module in the corporate issuer section. Again, my name is Darren Lee, and we will continue here with the next section on capital structure. Focus in this section is on the bottom right portion of the balance sheet, which is, of course, long-term debt and equity financing, otherwise known as capital structure. For study purposes, there are 4 key areas that you need to master in this section in order to succeed on the exam. So we'll start off with the first one, which there's already been quite a bit of allusion to, the fundamental goal in determining the optimal capital structure, which is, of course, to minimize the firm's weighted average cost of capital. So we'll go and do the basic calculations on that, and then we'll elaborate a bit more in the second part. We're going to look at factors that determine the firm's choice of and the investor's willingness to offer debt versus equity financing. The third concept here on Miller or Modigliani-Miller or M&M propositions makes it clear that it is actually the present value of future cash flows rather than capital structure that largely determines the firm's value. The assumptions used by M&M attempt to demonstrate the irrelevance of capital structure in determining the value of the firm. But in real life, once we consider the impact of both taxes and the costs of financial distress, then we see that the capital structure does affect value, but the effect is not significant. And then finally, for the fourth point, there's going to be some coverage relating to the firm's optimal versus target capital structures, and we'll explore that in a little bit of detail. Okay, so that should just give you a very nice overview of what we're going to be covering in the next hour or so. Now, keep in mind that the firm's required rate of return is alternatively called the cost of capital. So they're one in the same, okay? So as you can see, there are 2 components to this. The cost of equity, as you can see, is higher due to dividends being paid after interest, and of course equity represents a residual claim on assets on liquidation, so it doesn't have as secure a position as debt. If you look at debt, you can see 2 things. There's a priority fixed claim and often secured with collateral. So those 2 factors would lower the risk and therefore allow for a lower cost of debt. Now, earlier on, when we were doing the NPV and IRR calculations, there was a discount rate to consider, either as the required rate of return in NPV or the hurdle rate in IRR. Now, the discount rate is often the WACC, weighted average cost of capital, which is, as you will see, a blended rate of debt and equity. Okay? So if you look at the equation, the basic WACC calculation is presented, and you must ensure that you always apply the tax rate to the pre-tax debt cost, since debt is tax deductible in most jurisdictions. Also ensure that you do not use the financial statement numbers or book values in determining the weights for debt and equity. You need to look in the case facts to find the market values, unless they tell you specifically that book value is market value. then that's fine. But you need to actually check for that. So the basic calculation is just assuming debt and common shares. Possibly they could throw in preferred shares just as an extra component to the computation. That's fine. Just go along with it. The weightings will obviously have to still add up to 100% here. Let's do an example here, okay? This is a very basic WACC calculation. We are going to have to do two calculations here, but they are very similar because they only involve a rate change, a tax rate change from 20 to 25%. Okay, so you're essentially doing the same thing, but just plugging in a different number. So let's have a look and do this. See, we've got the capital structure of 30% and 70% equity, and then we've got the different cost of capital, 6% and 12%. Again, don't forget here that the 6% debt is tax deductible. All right, so here we go. Let's go and do the calculation. Do the first one here at a 20% tax rate here. And you can see that's incorporated here versus the 25% tax rate. So in the end, as you can see, the higher tax rate, right, the second equation here demonstrates that there's a greater benefit of the tax shield by lowering the firm's weighted average cost of capital, right? The difference here, of course, is 9 basis points. Okay, so that may be a question you could get on an exam. They might just ask you to do both calculations and just say what's the difference between the WACC. But point being that the tax shield impact is enhanced when the tax rate is higher. Okay. All right, let's move on to the next part here. Okay, another calculation for us to do. It's a bit more involved than the first one. There are two small subtleties to consider, right? The $600,000 book value of the shares suggests a book value of $15 per share. The market value of the bonds at the time of issuance is, of course, the same as the book value. And since there are no case facts in here indicating any change, then really we have no choice but to assume that the market value of the bonds remains at the $400,000 book value, right? I mean, there's nothing else that you can assume here. Okay, because the value of the stocks now are $25, because that's what it says so in the case facts, then the equity value, of course, is now going to have a market value of $1 million. And if you add in the $400,000 of bonds, the total capital is going to be $1.4 million. So as you know, the book value weights of debt and equity are irrelevant here. Instead, the correct weights we're going to use are going to be based on market value. So let's go and take a look at these computations here. Okay, so I've just kind of said here, value of bonds here is going to be staying at 400,000, and so once we continue here and see the weights, you'll see that the weights are 29% and 71% for debt and equity, respectively. Okay, so hopefully so far so good in this part of the calculation. We have the weights now. So let's put all of this together with the required rates of return. Okay. So here we go, and we're going to do this here for the debt and the equity. Again, make sure that for the debt, you take into account the tax rate of 20%. Okay. All of that together gives us a WACC of 8.26%. Now, applying this to an exam situation, I think something like this WACC calculation is a reasonable question for a competent candidate to perform in the required 1.5 minutes that you would have approximately on the exam. Now we're going to move next to some qualitative points here. I mean, we've explored everything we need to in terms of the quantitative stuff here, but on the exam, there will often be test questions that don't require you to calculate anything, but to actually understand what is actually going on behind those numbers. Okay, so in performing the analysis on a given firm, of course, the first step is to determine whether the firm is in a capital intensive or a capital light business. Okay, and I think that should be fairly intuitive here based on the examples that I provided here. If we start with a capital intensive business such as a bank, there are some common methods, of course, to reduce the financing costs, right? But regulations beyond the firm's control may partially or fully offset the savings in financing costs. So the financing costs here, they said, are listed in the bullets. Now, moving over to the bottom here, and capital light businesses such as technology companies may have substantial intangible assets that do not usually require external financing, so that results in a significant reduction in financing costs. Now, once we factor in any potential expansion plans that would presumably require more capital, then there could be a significant increase in the WACC. Okay, let's go a little bit further, right? Capital structures here are definitely not constant, and they will always be changing. So we should examine, and do some life cycle analysis as well. So there's two things that you need to be able to do once you have read and mastered the material. So first, given a set of case facts, you need to determine which of the three broad life cycle stages is being described. So the first step here is knowing what they are, and then you need to be able to apply that and spot and recognize which stage. So based on the life cycle stage, then the next thing you need to do is match it with the most likely source of financing. So the material on this slide basically is all the technical knowledge that you need to know. Okay? Now what I'm going to do on the next slide is apply the knowledge to a short example to sort of show you, okay, if you study this material here, right, and you look at, well, here's the description, right, let me just, so this is describe, and then the financing source. That's sort of parallel for all three examples. So you got to be able to take this knowledge and be able to apply it into a question setting. So let's do that. Okay, this one here is just a quick example. You won't get something like this exactly on an exam, but it sort of gets the idea across here. So looking at this, we can see in the early stages of the corporate life cycle, the only types of debt available are leases and convertible debt here. So the best answer here is that startup is going to match up to convertible debt. Now, business risk declines and free cash flow improves in the growth phase, but cash flow is still likely negative. So that means that secured financing, secured debt financing is most likely in the growth stage. And so then, of course, that leaves us maturity in the life cycle. Free cash flow here is positive and predictable. The firm is able to use a significant amount of debt here, including unsecured debt. So lenders are certainly more willing to lend to a more mature and established firm. In looking at macro factors impacting cost of capital, it is important, I think, to distinguish between the economic conditions or the financial market conditions versus the industry conditions, because they have different impacts, of course, right? The industry in which the firm operates. Now, if we look at the first one with the economic conditions, macroeconomic and country-specific factors such as real growth, inflation, monetary policy, and exchange rate changes can increase both interest rates and credit spreads. And when credit spreads are low, which implies higher bond prices, that encourages bond issuances. Now here, there are 4 points listed, and I'm going to briefly elaborate on each of these. I think in answering exam questions, it is important to understand the situations where each of the factors will increase or decrease the cost of capital. So I think that might ultimately be the question: increase, decrease, or no effect. Or the questions could focus on some of the aspects that I'll elaborate on. Okay, so let's start off with sales risks here. Okay, what can we say about that? Well, revenues that are stable and predictable and growing, right? So usually for large companies, will attract a lower cost of capital, right? Number 2, which tied into operating leverage with profitability, the higher the proportion of fixed costs to total costs in a company's capital structure here, or cost structure here, then the greater the sensitivity of changes in cash flows and profits for a given change in revenues. So as a result here, if there is more operating leverage, that is going to increase the cost of capital. Okay, so to the extent that there are more fixed costs. Now, similarly, we go to financial leverage. The current level of financial leverage is indicative of how much additional debt the company can take on. So we usually look at this with a metric, the debt equity ratio here. So it should be obvious that both the cost of debt and the cost of equity will increase the greater the leverage there is. So the greater the debt to equity ratio, for instance. Okay, and then the last one, which I think should be straightforward. Now, the existence of valuable or especially liquid collateral, such as cash or marketable securities, or in some cases, real estate as well, will lower the cost of debt. Okay, so that's how I would sort of look at these, right? I mean, you don't want to just memorize the list. You want to kind of think about the impacts on the cost of capital. So we've got a practice question. This is a quick example of material that we just covered regarding higher cost of capital. Now, using the process of elimination, what we can do here is we can get rid of answer A, because stable revenue growth would lower the cost of capital. And the question is asking for, of course, higher cost of capital. Now, the other thing that we can do here is answer choice C. High interest coverage is actually very good, right? Because this means relatively low debt and low financial leverage, and that would lower the cost of capital. Okay, so then that would only leave us answer B, which is correct, right? Since higher operating leverage implies greater risk and therefore a higher cost of capital. Okay, so as I said, you can see that, if you know the answer right away, then just pick it. But the process of elimination is often a very good technique here for learning purposes and to help you understand why these distractors are there and how you can efficiently eliminate them. Okay, now I'm going to continue into a series of calculations now, these numerical examples covering both operating leverage and financial leverage. And they're going to be very important and testable concepts. You are responsible for both operating and financial leverage, both from a computational and qualitative perspective. Okay, so looking first here at the required at the bottom. Okay, like what are the questions that they are asking, and then we will tie it back to the case facts afterwards. So our approach here should be to create a table to compare the two scenarios, right? Of a 25% sales increase and a 25% sales decrease for each company. Okay, so you're gonna have like 4 items in total, right? Because there's increase and decrease, and there's two companies. Now, once we have calculated the ROE amounts, then we can make a conclusion on the company with the lower cost of debt. Now, also, you need to assume here that the equity number we're using of 100 is the beginning equity. Since it is obvious that the ending equity is going to differ between the two scenarios, given the difference in retained earnings caused by the differences in sales. Okay, so equity is 100 for both companies. This is the beginning value that we're going to use. Okay, and that's the only way to keep it constant. Now we know that the opening ROE in both scenarios is 30%, but we are interested in examining the changes. Now, before jumping into the details of the calculations, be sure to step back and look at the big picture, right? Remember that operating leverage here is all about analyzing companies with differences in their fixed costs. Okay, so you can see that company 1 has higher fixed costs of 50. Company 2 has lower fixed costs of 20, even though they have the same total expenses and revenue. So we're going to go through and we're going to do the computations here for company 1. Okay, so the 25% decline in sales is going to lead to a revised profit, right, of 10. And so that's going to lead to a revised ROE of 10%. Okay, we made these numbers nice and round really easy. Okay, So great, that's pretty clear. Now the 25% increase in sales is going to lead to a revised profit of 50 and therefore an ROE of 50%. Okay. All right. Let's continue here and look at company 2 and then do a comparison. Okay, so this is the same thing here, but let's see how this operates, or the effect is based on differing fixed costs. All right, now the 25% decline in sales, of course, is going to lead to a revised profit of 17.5 and an ROE of 17.5%. Correspondingly, the 25% increase in sales leads to a revised profit of 42.5 and an ROE of 42.5%. Okay, so let's just stop for a second here and let's talk about what's going on here. Okay, so the cost of debt for company 2, of course, is likely lower since its profitability is more stable than company 1. Right? So company 2 here experiences only a small drop, right? Well, relatively small drop, 12.5% drop in ROE as a result of the 25% sales decrease. Whereas company 1, if we go back there, let's go back to company 1 here. So in company 1, if we do a little bit of a sensitivity analysis, you can see here that there is a 20% drop in ROE for the same sales decrease. So in that regard, we could say that company 2 has more profit stability than company 1. And so such profit stability comes from company 2 having more variable costs and lower operating leverage than company 1. Now to the parallel analysis for financial leverage. This time, instead of fixed costs, we're going to focus on interest expense. Now, the big picture is that firm A has lower interest expense than firm B. And this is, of course, for the same level of sales and non-interest expenses. Let's do the analysis, okay? We're going to start here with firm A. The profit calculations, as you can see on this slide, are pretty straightforward because it's simply operating income minus interest expense. And we're told explicitly to ignore income tax. So the interest coverage ratio is computed as operating expense divided by interest expense. So I'm just going to say here it's A divided by B, okay? And if you do that, you get your interest coverage ratios, okay? So that's a potential calculation that you're responsible for. Okay, then the next thing here is we want to look at ROE, okay? So I'm going to go here, C and D. So ROE, of course, is computed as profit divided by total equity. So C divided by D, and that is going to give us 35%, 26%, and 44%. So what we're seeing here is we're seeing a 9% range here. So the decline is going to take us down 9% for ROE, and the increase is going to take us up 9%. So let's go and do the same thing here for firm B. Okay, so to answer the big question about which firm likely has the lower cost of capital, we'll see here that it's going to be firm A, which is primarily financed with equity. So take a look at the numbers here. We've got interest coverage ratio here, and then we've got our ROE. And notice that the range here is quite high at 19%. So there's a lot more sensitivity variability. So if you take a look here, firm B, right? If you look at the initial base case ROE, it is 53%, okay? And that, sorry, let me just go back here, and I'll show you that that's quite a bit higher than for firm A, and it has higher upside as well if operating income actually increases. And so it has a much wider range of outcomes owing to its higher leverage. So as you can see, the range for ROE is wide, between 34% and 71%. For firm A, it is only 26% to 44%. So going further, even in the downside case, right, firm A's interest coverage ratio is over 10. And therefore, it can withstand a greater than 90% decline in operating income before its ability to make interest payments is seriously imperiled. Now, in practice, I will say that investors would, amongst other things, evaluate the stability of sales and operating leverage in developing an outlook for both firms. So while firm A has lower financial leverage and higher interest coverage, it could still have greater operating leverage and higher sales risk than firm B, okay? Because all we did here was we only looked at financial leverage, but keep in mind there's, of course, other factors. All right, off to Modigliani Miller here. So MM1 and MM2 are theoretical extremes intended to show that once the many unrealistic assumptions are relaxed, capital structure does have an impact on firm value when we look at taxes and potential bankruptcy costs specifically. Okay, so again, I'll make this real clear. This is completely unrealistic. Okay, these assumptions would not hold in real life, like all of them. Okay. All right, so that's that. Now let's go on and take a look at some of the details here. Now, MM1, this is the basic proposition, but as we know right away, so I'm not going to spend too much time on this here, it's not realistic at all, right? I mean, it says without taxes, but we know in real life here, taxes are everywhere. Okay, the firm value is the combined value of debt and equity, which makes sense. So I will just sort of say at this point, this proposition does have some basis when we look later on at equity valuation, right? Since company value is largely driven by expected future cash flows, as we demonstrate in the dividend discount model or the free cash flow models, for example. Now here, the key concept is that with more debt comes more risk of bankruptcy or financial distress. Okay, therefore that means equity investors must be provided with greater compensation for taking on that additional risk. So that's sort of a key point here. We're just talking about how more debt actually negatively impacts the equity holder's position. So for now, with no taxes, what we do is we assume a linear and positive correlation between the cost of equity and the amount of debt in the capital structure, right? Which is the basic idea. Not exactly correct, but it is the basic idea. So in the absence of taxes, this would affect the cost of debt. The lower cost of debt is counterbalanced with the higher cost of equity, which results in no change in company value. Okay. Now note that bankruptcy is possible, but there is no explicit bankruptcy cost to consider in this example. So here's a graphic of everything we spoke about in the previous slide. Okay, so as you can see in this diagram, the cost of debt, right, stays constant. What happens here is there's an upward sloping straight line, and so that is to indicate here that the more debt there is in the capital structure, the greater the cost of equity, and you can see that very clearly in the diagonal line. So that is also confirmed, right, if you look at this equation, and that equation is consistent here for calculating the cost of equity, which has debt to equity ratio as one of the independent variables. And also note RO is the cost of capital for a company financed only with equity. Let's work through a basic example of M&M. We illustrate here the value of the firm stays at $50,000. So that implies that the WACC will stay at 10% as well. So the more interesting part is to compute the cost of equity. All right, so this slide here gives you all the background information. We're going to now do the cost of equity calculation in the following slide. So the cost of equity, we're going to follow the equation that we saw recently based on a starting point of 100% equity financing with a cost of 10%. So from there, we increase the amount based on the difference between the cost of equity and the cost of debt, as well as the debt to equity ratio. So that's everything here that we're doing, and that's going to give us 12.143%. So that's a nice review of what we just did earlier. And then we have to apply the WACC calculation based on the 5% cost of debt and the 12.143% cost of equity that we determined just now. So applying the relevant weights, right, you can see that we're going to get 10% for WACC as expected. All right, so there is there's your proof there of the constant WACC. In this example, we're going to continue with. We're going to break out the annual cash flows of $5,000, and so we know that the first $750 has to be allocated to the debt holders based on the 5% interest on the new debt of $15,000. So by default, this is $4,250 is the remaining that's going to revert to the equity holders. So to value the debt and equity as a perpetuity, as stated in the assumptions in the case facts, we're going to use those cash flows in the numerator and the cost of capital in the denominator. And so if we do that, let's go and do the calculations. So we got $15,000 for the first one, and we've got $35,000 for the second one, right? Just doing this exactly the way that I mentioned. And that is going to add up to $50,000. So alternatively, the $750 for the debt and the $4,250 for the equity add up to $5,000 in the numerator, and then applying 10% WACC in the denominators as the cost of capital, we also get $50,000. Okay, so there's a number of ways around here to show you the proof. Moving on to something a little less theoretical and more realistic. Okay, now we're going to consider taxes, and we see that once we consider the impact of taxes, the cost of debt is lowered, and on the basis of the tax shield, it will increase the value of the firm. So as we showed you earlier, the greater the tax rate, the greater the tax shield, and therefore the greater the value of the firm. So we're going to illustrate the concept in equation format, okay? And I'm just going to point this important term out to you, right? We're going to add the 1 minus t to the earlier equation. So that means the cost of equity will still rise with more debt, but it won't rise as rapidly. Okay, so it's just a slight extension to what you already know. Okay, and just for full effect here, let's take a look at all of this in graphical format. So before, without taxes, the WACC was a straight line, right? But now what we're going to have here is that the WACC, weighted average cost of capital here, is actually a downward sloping diagonal line. Okay? Note that the after-tax cost of debt here does remain constant as we increase leverage due to the assumption of no costs of financial distress. Okay, so all of this leads us to the preliminary conclusion that we're going to maximize the value of the firm if the capital structure is 100% debt. Now, that sounds totally appealing in theory, but we're going to find out shortly that that is not realistic. So this is a similar numerical example as before, except all we're going to do is we're going to add a little bit here on the tax rate. Okay, we're going to add this at 25% here. Okay, that's fine. This will of course decrease the after-tax cash flow to from 5,000 down to 3,750. It will also reduce the firm value down to 37,500 from 50,000. Okay, great. This time the calculation of all three items is a little bit more interesting than before, as we will find out. All right, so the value of the firm is not exactly 37,500, but instead we have to factor in the tax shield relating to the debt. Okay, so 37,500 was a starting point, but we've got to then take into account the benefit of the tax shield. So what this is going to do is this is going to add 25% of 15,000 or 3,750 in order to give us a revised value of the firm of 41,250. Now the debt value is still the same at 15,000, and that's going to leave 26,250 as the equity value. Okay, so that's the change here once we take into account the tax shield. Now, you may be confused that earlier we said the cost of equity rises at a slower rate when tax is included. Now, that is, of course, true, but in the end, the cost of equity is still the same at 12.143% after dealing with the buyback. So notice that with taxes, the proportion of leverage is different. Okay? you will see here that with no tax, of course, debt equity ratio here is 42.9%. With tax, then the debt equity ratio is 57.1%. So therefore, the cost of equity is the same, but leverage is higher with tax, then the cost of equity must have been rising at a slower rate. So WACC at the end here, as you can see, has gone down with a lower cost of debt. The WACC is not 10% anymore, but it's gone down to 9.09%. Okay. All right. So just wanted to make that clear. And again, I was pointing out the debt equity ratios here have changed as well. Okay. So we concluded earlier that the value of the levered firm is $41,250. And so just for good measure here, I can give you a mathematical proof as follows. Okay, so here we go. The $37.50 total after-tax cash flow is valued as a perpetuity using the 9.091% WACC to arrive at $41,250. Now, if we subtract out the value of debt of $15,000, which is not changed, then we are left with the residual of $26,250. Now, additionally, from an equity perspective, the starting point is the $37.50 total after-tax cash flows, and then we subtract out $37.50 paid as interest, and then we add back $750 times 0.25 or 187.50. That will give us 3187.50 as the after-tax cash flow to equity holders. Okay, and so let me just illustrate that to you. That's going to give you 3187.50, and if we use the cost of equity at 0.12143, that's going to give you 26,250. Okay, so that's another way of looking at it. So just to point that out, that is 3750 minus 750 plus 187.50. Okay, and that 187.50, of course, is 750 times 0.25. Okay. So just to sort of give you all of this so you can see how we reconcile the numbers in the end. With static trade-off theory, the new element to include, as we had alluded to earlier, of course, is this last component here, the cost of financial distress, which essentially negates the potential for capital structure to be 100% debt. All right. Now let's take a moment here to review the key elements of the cost of financial distress. So it is the greater risk of a company not being able to discharge its obligations due to financial losses or reduced earning power. So it includes direct costs such as higher interest rates and indirect costs such as opportunity costs, reputational damage, and loss of key staff. Okay, so just to get a flavor of what this is. Okay, now there is an increased probability of financial distress with greater operating financial leverage, as well as lower liquidity. Okay, so you've got to of course tie this to things that we had looked at before. Okay, and leverage being both operational and financial in nature. Now, on the other hand, there are decreased cost of financial distress if tangible assets exist that can be readily liquidated. So try to look at it from both sides here. So let's take a look at a diagram here. Okay, this entire concept of static trade-off theory, I think, can be very clearly demonstrated here. Okay, so the value of a levered firm is greater than the unlevered firm, right, as illustrated with the green line, but only up to a certain point, right? Now, with the introduction of the red line, you can see that there comes a certain point. You can think of it as diminishing returns or whatever. But it is really just trying to indicate here that there is an optimal debt level which maximizes firm value. And that debt level has to be less than 100% of the capital structure. So you can see the difference between the red and the green line as the present value of financial distress. So we need to figure out where is that point where the firm value is maximized, and it is right here. So it is not here, right? This is the point where the red line, the value, is moving slower here up than the green line, but it is still rising. But it's just that after where I've circled it, the value is actually starting to drop. Okay, and that's what you need to understand here. So this slide and the rest of this is going to be qualitative in nature. So if you are tired of all these numbers here and calculations, well, that's great, because now we're just going to focus on points that are non-numerical in nature. So this slide here reviews the salient points that you should know, and you should be able to recognize the various reasons why actual capital structure may not be the same as target capital structure. Now, this is despite all the best efforts to be at the target capital structure all the time. Right? In theory, that's what you want, but it's just not always going to happen. Now, given the many estimates involved, it makes sense that the target capital structure is expressed here, of course, as a range of values, okay? Rather than one very pinpointed arbitrary amount. So what's slightly confusing is that target capital structure is often determined using book values, okay? And that's the confusing part here, because we tell you when we are determining the weights are based on market value. But if we're doing specifically target capital structure, then you have to remember that we're using book values. And that's, as I said, very different from the way we calculate WACC. So for exam purposes, make sure you are absolutely clear that we are dealing with two totally different circumstances, okay? Calculating weighted average cost of capital is not the same as determining target capital structure. So you've got to read the question carefully and know what context you're in. WACC is based on market values. Here, target capital structure on book values, okay? All right, pecking order theory. Now, when investors perceive that company management are likely to use their insider information to their advantage when seeking financing, then of course these investors will demand higher returns due to the concern that the new securities will be overpriced. Okay, and that's the sort of whole point we're getting at here in this first bullet point. So another way of expressing that is that there's concern that the firm will either issue equity when the share prices are expensive, or issue new debt when the firm's creditworthiness is about to decline. So the signaling model of capital structure then suggests a hierarchy of methods for financing new investments. Okay, So on this slide, I am going to continue on that hierarchy. So public equity offerings often raise questions and concerns amongst investors because existing owners would seem less likely to want to share ownership of a company with strong future prospects, right? So because of that, managers prefer internal financing, and only if external financing is absolutely needed, then in that case, they prefer private debt to public debt and prefer equity issuances least of all. Okay, and that's indicated here on this first bullet point. And so this is just an issue here of signaling. I mean, equity, is the biggest signal. Everybody knows that, but private debt is not as public a signal, for instance. Okay. Issuers tend to issue equity when management believes the stock is overvalued, and of course they are reluctant to issue equity if they believe the stock is undervalued. Right? So potentially choosing instead to repurchase shares. So the additional issuance of equity, usually to finance an acquisition, is often interpreted by investors as a negative signal. Okay, the issuance of debt commits the company to future principal and interest payments, which along with recurring dividends may be interpreted as a sign of management confidence in the company's future ability to make such payments. Okay, so just was really trying to elaborate on each of these 3 points on pecking order theory. Now, as a quick review, agency costs we saw earlier are incremental costs arising from conflicts of interest between managers, shareholders, and bondholders. So in that context, the more financially leveraged a company, the less freedom for managers to take on more debt or to spend cash unwisely. So the use of debt financing is, in that sense, a good thing to avoid agency costs. All right, so let's look at a final slide here. Just a brief example of asymmetric information and signaling that could occur in real life. Okay, so to demonstrate the asymmetric information, have a look at the case facts here. All right. So notice the time difference, okay? So we've got in July and in August. So there's a 1 month time difference between management knowledge of the positive results of the clinical trials in July and then the subsequent public announcement in August. Okay, so to demonstrate signaling, we see the taking on of additional debt back in July as a sign of confidence that the company will be able to repay the borrowings plus interest based on future cash flows generated by the company, right? And so that debt here is the increase in its credit line. So that confidence may be a signal then that those clinical trials were successful.